Good morning, traders, investors, and viewers of Alpha Market Meridian. This is your daily deep dive into the markets, where we turn charts, headlines, and volatility into actionable strategies for your portfolio. Right now, two of the world's most critical assets are moving in opposite directions, gold in a confirmed downtrend, and crude oil in a relentless uptrend. And today, we're not just going to analyze why this is happening. We're going to show you exactly how to profit from both, step by step, with risk-managed strategies tailored to 2026 unprecedented market conditions. Over the past 90 days, we've watched gold shed nearly 20% from its all-time highs, while Brent crude has surged over 30%, creating one of the most starkly correlated inverse relationships in modern commodity history. But before you jump into trades, we need to break down the why behind these moves, the technical signals confirming their trends, and the catalysts that will determine where they go next. This isn't a one-way bet, this is a structured, multi-timeframe playbook for both assets, designed to maximize returns while protecting your capital. Let's start with the hard data by using the 60 minutes and 1-day charts. Part 1, Gold, the downtrend in full bloom, technical and fundamental analysis. First, let's dissect the gold charts. We're looking at two key timeframes here, the 60-minute intraday view, and the daily trend chart, both of which paint a clear bearish picture, starting with the 60-minute chart. As you can see, gold is currently trading at $4,559.83, up 0.36% in the session, but this is nothing more than a dead cat bounce in a confirmed downtrend. Let's break down the moving averages first. The 5-period MA sits at $4,552.75, the 10-period MA at $4,548.10, the 20-period MA at $4,557.75, the 40-period MA at $4,576.50. Notice anything? The price is still below the 20 and 40-period moving averages, and even the 5 and 10-period lines are barely holding above the current price. This is classic bearish alignment. The shorter-term moving averages are below the longer-term ones, and the price is struggling to break above even the 20-period line. The MACD confirms this. After a brief bullish crossover, the histogram is already starting to shrink, and the signal line is flattening out, meaning the short-term bounce is losing steam, and the bears are ready to take control again. Now, let's zoom out to the daily chart, which tells the real story. Since peaking at $5,419.01 in late February 2026, gold has carved out a textbook bearish structure, lower highs and lower lows, with every attempt at a rally failing to break above the key moving averages. The 50-day MA, once support, is now acting as a dynamic resistance level, currently sitting at $4,618.02. The 100-day MA at $4,689.88 and 200-day MA at $4,716.35 are even further above the current price, forming a solid wall of overhead resistance. The MACD on the daily chart is just barely above the zero line, with red bars starting to print, indicating that the long-term momentum is still firmly to the downside. Fundamentally, the case for gold's decline is equally compelling, and it's not just about one factor, it's a perfect storm of headwinds that have rewritten the rules for the yellow metal in 2026. First, the Federal Reserve's policy pivot. After months of market pricing in aggressive rate cuts, the Fed has hit the brakes, and the data is proving why. Inflation, while cooling, remains sticky, with core PCE still running above 3% year-over-year. The labor market, meanwhile, is showing surprising resilience. Initial jobless claims are hovering near multi-year lows, and wage growth is still too hot for the Fed to cut rates anytime soon. The result? Market expectations for 2026 rate cuts have been slashed from 75 basis points to just 25 basis points, and the US dollar has responded by strengthening against a basket of currencies, including the euro, yen, and pound. Since gold is priced in dollars, a stronger greenback makes the metal more expensive for foreign buyers, putting constant pressure on prices. Second, the shift in safe haven flows. For years, gold was the go-to asset during geopolitical uncertainty, but 2026 has flipped that script. Right now, the biggest risk event in the world is the ongoing standoff in the Strait of Hormuz, where tensions between the US and Iran have disrupted global oil shipping. Normally, this would send gold soaring, but instead, traders are flocking to oil as the ultimate hedge against supply disruptions, leaving gold in the dust. This isn't a temporary shift, it's a structural change in how markets price risk, and it's clear that energy assets are now the preferred safe haven in this geopolitical environment. Third, ETF outflows are accelerating. In March 2026, gold ETFs saw their largest monthly outflow in a decade, with investors pulling over $12 billion from the SPDR Gold Trust alone. The trend has continued into April, with outflows averaging $500 million per week. This is a direct vote of no confidence in gold's short-term prospects, and it's creating a self-reinforcing cycle, as ETFs sell gold to meet redemptions, prices fall, which triggers more redemptions, which leads to more selling. Fourth, the technical breakdown we're seeing is triggering forced selling from systematic funds. Many trend-following hedge funds use moving averages and price levels to determine their positions, and when gold broke below the $4,600 support level earlier this month, it triggered stop-loss orders that pushed prices even lower. We saw the same thing in March, when the break below $4,800 led to a 10% single-week drop in gold prices. Now, let's talk about the key levels you need to watch to trade gold effectively in this downtrend. On the downside, the first major support level is the recent low at $4,510.21. If that breaks, the next target is the psychological level at $4,480, which lines up with the 61.8% Fibonacci retracement of the entire rally from the 2023 lows to the 2026 highs. Below that, we're looking at $4,350, which was a key consolidation level in late 2025. On the upside, the first resistance is the 20-period MA on the daily chart at $4,619. The next major resistance is the 50-day MA at $4,689, and above that, the 100-day MA at $4,716. Any rally that fails to break above these levels is a textbook opportunity to sell into strength. But how do you actually profit from a downtrend without getting caught in false breakouts or overextending yourself? Let's break down the 3 most effective strategies for gold in 2026, tailored to different risk profiles. Part 2, strategies for trading gold in a downtrend, risk-managed plays. First, let's address the elephant in the room. Shorting gold carries risks, especially when sentiment can shift on a dime. But with the right rules, you can manage that risk and turn the downtrend into consistent profits. Let's start with the most conservative strategy, then move to more aggressive plays. Strategy 1, sell on rise, swing trading for beginners. This is the most straightforward and risk-managed way to trade a downtrend, and it's perfect for traders who don't want to hold positions overnight or take on excessive leverage. The rules are simple. Wait for a bounce to a key resistance level. We'll use the 20-period MA on the 4-hour chart, which is currently around $4,570. Confirm the bounce is failing. Look for a bearish candlestick pattern, like a shooting star or bearish engulfing candle, at that resistance level. Enter a short position with a stop-loss just above the resistance level, e.g., $4,600. Take partial profits at the nearest support level, e.g., $4,520, then move your stop-loss to break even on the remaining position. Let the rest of the position run to the next support level, e.g., $4,480. The beauty of this strategy is that you're never chasing the market, you're waiting for the market to come to you, and you're only entering trades with a defined risk-reward ratio of at least 2:1. For example, if you enter at $4,570 with a stop at $4,600, 30 points of risk, Your first target at $4,520 gives you 50 points of profit, a 1.67 to 1 ratio, and your second target at $4,480 gives you 90 points of profit, a 3 to 1 ratio. This way, even if you get stopped out on half your trades, you'll still come out ahead over time. Strategy 2, Bear Flag Breakdown, technical play for intermediate traders. As we look at the 60-minute chart, gold is currently forming a classic bear flag pattern, consolidating in a narrow range after a sharp drop, with the flag sloping slightly upwards. This is a continuation pattern, and it typically resolves to the downside, with a measured move equal to the height of the preceding flagpole. The rules for this trade are: identify the flagpole, the sharp drop from $4,620 to $4,510, which is 110 points tall. Identify the flag, the current consolidation between $4,540 and $4,570. Enter a short position on a break below the flag support at $4,540, with a stop loss above the flag resistance at $4,580. The measured move target is the flagpole height subtracted from the breakout point, $4,540. 110 equals $4,430. This is a high probability trade, but it requires patience. You can't enter the trade until the breakdown is confirmed. If the price breaks above the flag resistance instead, the pattern is invalid, and you should avoid the trade entirely. Strategy 3, put options on gold ETFs, long-term, low-risk play. If you're a longer-term investor who doesn't want to short the physical market or use leverage, put options on gold ETFs like GLD or XAUUSD are a great alternative. With put options, you're buying the right to sell the ETF at a fixed price by a certain date, which means your maximum loss is limited to the premium you pay for the option. For example, if GLD is currently trading at $175 per share, you could buy a July 2026 put option with a strike price of $170 for a premium of $5 per share. If GLD falls to $160 by expiration, your profit is $170 to $160, $5 equals $5 per share, a 100% return on your investment. If GLD rallies above $170, your maximum loss is just the $5 premium you paid. This strategy is perfect for investors who want to bet on gold's decline without the risk of margin calls or unlimited losses. The key is to choose options with enough time until expiration, at least 3 to 6 months, to give the downtrend time to play out, and to avoid buying options that are too far out of the money, as they have a low probability of expiring in the money. Now, before we move on to oil, let's talk about the risks of trading gold in this downtrend. The biggest risk is a sudden shift in Fed policy or a major geopolitical event that triggers a flight to safety. For example, if the Fed signals a surprise rate cut, or if tensions in the Middle East escalate further, gold could rally 5 to 10% in a single day, wiping out short positions. That's why stop losses are non-negotiable, and why you should never risk more than 1 to 2% of your trading capital on any single gold trade. Part 3, Oil, the uptrend in full bloom, technical and fundamental analysis. Now, let's turn our attention to the other side of the coin, Brent crude oil, which is currently trading at $110.58, down 1.14% in the session, but still up over 30% from its February lows. Let's break down the charts, starting with the 60-minute intraday view. The 60-minute chart shows a relentless uptrend, with the price trending above all the moving averages. The 5-period MA at $110.99, the 10-period MA at $110.46, the 20-period MA at $108.15. The 40-period MA at $106.10. Notice how the moving averages are perfectly aligned in bullish order, shorter-term averages above longer-term averages, and the price is holding above all of them, even during today's pullback. The MACD on the 60-minute chart is above the zero line, with the histogram still printing red bars, but this is just a minor pullback in a strong uptrend. The signal line is still above the MACD line, and the histogram is far from crossing below zero, meaning the bullish momentum is still intact. Zooming out to the daily chart, the the picture is even clearer. Since hitting a low of $69.18 in late February 2026, Brent crude has carved out a textbook bullish structure, higher highs and higher lows, with every pullback finding support at the rising moving averages. The 50-day MA at $107.02, the 100-day MA at $102.86, and the 200-day MA at $101.28 are all sloping upwards, forming a solid foundation of support. The MACD on the daily chart is above the zero line, with the histogram still printing green bars, confirming that the long-term momentum is firmly bullish. Fundamentally, the case for oil's rally is even more compelling than gold's decline, and it's driven by three irrepressible forces: supply disruptions, tight inventories, and resilient demand. First, the Strait of Hormuz crisis. The Strait of Hormuz is the world's most critical oil shipping lane, with roughly 20% of global oil supply passing through it every day. Since tensions between the US and Iran escalated in April, shipping through the strait has dropped by over 40%, with many tanker companies rerouting their ships to avoid the risk of attacks. This isn't a temporary disruption. The conflict shows no signs of de-escalating, and the US has deployed additional naval forces to the region, raising the risk of direct military confrontation. The result is a structural supply deficit that the market is scrambling to price in, and every day the strait remains partially closed, oil prices get more support. Second, OPEC Plus production cuts are still in place, and they're working. In late 2025, OPEC Plus agreed to extend their 2.2 million barrel per day production cuts through the end of 2026, and compliance with the cuts has been near perfect, especially from Saudi Arabia, which has voluntarily cut an additional 1 million barrels per day. With the Strait of Hormuz disruptions adding to the supply deficit, the global oil market is now undersupplied by roughly 1.5 million barrels per day, according to the International Energy Agency, IEA. Inventories in the US and Europe are already at multi-year lows, and there's no spare capacity to make up for the lost supply. Third, demand is holding up better than expected. Despite fears of a global slowdown, oil demand in 2026 is still growing at a rate of 1.2 million barrels per day, according to the IEA. China's oil imports are at record highs, as the country ramps up its manufacturing and construction sectors. The US driving season is also just around the corner, which typically leads to a 5 to 10% increase in gasoline demand, putting further pressure on crude oil inventories. Even Europe, which has been struggling with a mild recession, is seeing oil demand stabilize as natural gas prices remain high, leading to a shift back to oil for power generation. Now, let's talk about the key levels you need to watch to trade oil effectively in this uptrend. On the upside, the first major resistance is the recent high at $111.29, which we hit earlier today. If that breaks, the next target is the psychological level at $115, which was a key resistance level in 2022. Above that, we're looking at $120, which is the highest level Brent crude has ever traded at. On the downside, the first support is the 20-period MA on the daily chart at $108.15. The next major support is the 50-day MA at $107.02, and below that, the 100-day MA at $102.86. Any pullback to these levels is a textbook opportunity to buy the dip, but how do you actually profit from an uptrend without getting caught in false breakouts or overextending yourself? Let's break down the three most effective strategies for oil in 2026, tailored to different risk profiles. Part 4, strategies for trading oil in an uptrend. Risk-managed plays. Trading oil in an uptrend is generally more straightforward than shorting gold, but it still requires discipline and risk management. Let's start with the most conservative strategy, then move to more aggressive plays. Strategy 1, buy the dip, swing trading for beginners. This is the mirror image of the sell-on-rise strategy for gold, and it's perfect for traders who want to capture the long-term uptrend without chasing the market. The rules are simple. Wait for a pullback to a key support level, we'll use the 20-period MA on the 4-hour chart, which is currently around $108, confirm the pullback is stabilizing, look for a bullish candlestick pattern, like a hammer or bullish engulfing candle. At that support level, enter a long position with a stop loss just below the support level, e.g., $106, take partial profits at the nearest resistance level, e.g., $111, then move your stop loss to break even on the remaining position. Let the rest of the position run to the next resistance level, e.g., $115. The beauty of this strategy is that you're buying into strength, not chasing it, and you're only entering trades with a defined risk-reward ratio of at least 2 to 1. For example, if you enter at $108 with a stop at $106, 20 points of risk, your first target at $111 gives you 3 points of profit, a 1.5 to 1 ratio, and your second target at $115 gives you 7 points of profit, a 3.5 to 1 ratio. This way, even if you get stopped out on half your trades, you'll still come out ahead over time. Strategy 2, Bull Flag Breakout, technical play for intermediate traders. As we look at the 60-minute chart, oil is currently forming a classic bull flag pattern, consolidating in a narrow range after a sharp rally, with the flag sloping slightly downwards. This is a continuation pattern, and it typically resolves to the upside, with a measured move equal to the height of the preceding flagpole. The rules for this trade are: identify the flagpole, the sharp rally from $103 to $111, which is 8 points tall. Identify the flag, the current consolidation between $109 and $111. Enter a long position on a break above the flag resistance at $111, with a stop loss below the flag support at $108. The measured move target is the flagpole height added to the breakout point, $111 plus 8 equals $119. This is a high probability trade, but it requires patience. You can't enter the trade until the breakout is confirmed. If the price breaks below the flag support instead, the pattern is invalid, and you should avoid the trade entirely. Strategy 3, long call options on oil ETFs, long-term, low-risk play. If you're a longer-term investor who doesn't want to trade the futures market or use leverage, long call options on oil ETFs like USO or oil are a great alternative. With call options, you're buying the right to buy the ETF at a fixed price by a certain date, which means your maximum loss is limited to the premium you pay for the option. For example, if USO is currently trading at $45 per share, you could buy a July 2026 call option with a strike price of $50 for a premium of $3 per share. If USO rises to $60 by expiration, your profit is $60 to $50, $3 equals $7 per share, a 233% return on your investment. If USO falls below $50, your maximum loss is just the $3 premium you paid. This strategy is perfect for investors who want to bet on oil's rally without the risk of margin calls or unlimited losses. The key is to choose options with enough time until expiration, at least 3 to 6 months, to give the uptrend time to play out, and to avoid buying options that are too far out of the money, as they have a low probability of expiring in the money. Now, before we move on to combining gold and oil trades, let's talk about the risks of trading oil in this uptrend. The biggest risk is a sudden de-escalation in the Strait of Hormuz crisis, which could trigger a sharp correction in oil prices. For example, if the US and Iran reach a diplomatic agreement to reopen the strait, oil could fall 10 to 15% in a single day, wiping out long positions. That's why stop losses are non-negotiable, and why you should never risk more than 1 to 2% of your trading capital on any single oil trade. Part 5, Combining Gold and Oil Trades, the Ultimate 2026 Portfolio PLAYBOOK. Now that we've broken down individual strategies for gold and oil, let's talk about how to combine them into a single, balanced portfolio that profits from both trends while minimizing risk. This is the Ultimate 2026 Playbook, designed to capture the inverse correlation between gold and oil and turn it into consistent returns. First, let's talk about the correlation between gold and oil in 2026. Over the past 90 days, the correlation coefficient between the two assets has dropped to minus 0.8, meaning they're moving in almost perfect opposite directions. This is rare, but it's happening right now because of the unique market conditions we're facing. Oil is rallying on supply disruptions and demand growth. Gold is falling on a stronger dollar and a shift in safe haven flows to oil. This inverse correlation means that combining short gold and long oil trades creates a natural hedge for your portfolio. If one trade goes against you, the other is likely to go in your favor, reducing the overall volatility of your portfolio. Let's break down a sample portfolio allocation for a $10,000 trading account. *** short gold swing trade, 30% of capital, $3,000 *** using the sell on rise strategy. Enter a short position on gold when it bounces to $4,570. With a stop loss at $4,600 and targets at $4,520 and $4 for $80. *** long oil swing trade, 30% of capital, $3,000 ** using the buy the dip strategy. Enter a long position on oil when it pulls back to $108, with a stop loss at $106 and targets at $111 and $115. *** long oil call options, 20% of capital, $2,000 ** buy call options on USO with a strike price of $50 and an expiration date of July 2026, to capture the long-term uptrend in oil. Cash reserve, 20% of capital, $2,000. Keep 20% of your capital in cash to take advantage of future opportunities, like a major correction in oil or a breakdown in gold. This allocation gives you exposure to both trends while keeping your risk manageable. Let's walk through 3 different scenarios to see how this portfolio performs. Scenario 1, both trades go as planned. Bull case for oil, bear case for gold. Gold falls to $4,480, resulting in a profit of $90 per contract on the short trade. Oil rises to $115, resulting in a profit of $7 per contract on the long trade. The call options on USO rise to $10, resulting in a profit of $7 per share. Total portfolio return, approximately 15 to 20% over the course of 3 months. Scenario 2, gold rallies unexpectedly, but oil continues to rise. Bear case for gold short, bull case for oil. Gold rallies to $4,600, resulting in a loss of $30 per contract on the short trade. Oil rises to $115, resulting in a profit of $7 per contract on the long trade. The call options on USO rise to $10, resulting in a profit of $7 per share. Total portfolio return, still positive, as the oil gains offset the gold losses. Scenario 3, oil corrects unexpectedly, but gold continues to fall. Bull case for gold short, bear case for oil long. Gold falls to $4,480, resulting in a profit of $90 per contract on the short trade. Oil falls to $106, resulting in a loss of $2 per contract on the long trade. The call options on USO fall to $2, resulting in a loss of $1 per share. Total portfolio return, still positive, as the gold gains offset the oil losses. As you can see, this balanced portfolio is designed to profit in all 3 scenarios, thanks to the inverse correlation between gold and oil. The key is to keep your position sizes small, use stop losses, and take profits at key levels to lock in gains. Part 6, Final Thoughts, Navigating 2026's Commodity Markets with DISCIPLINEAs. We wrap up today's deep dive. Let's recap the key takeaways. Gold is in a confirmed downtrend, driven by a stronger dollar, Fed policy, and a shift in safe haven flows. The best strategies are sell on rise, bear flag breakdowns, and put options. Oil is in a confirmed uptrend, driven by supply disruptions in the Strait of Hormuz, OPEC+ cuts, and resilient demand. The best strategies are buy the dip, bull flag breakouts, and call options. Combining short gold and long oil trades creates a natural hedge, thanks to their inverse correlation in 2026. Risk management is non-negotiable. Always use stop losses, never risk more than 1 to 2% of your capital on any single trade, and keep a cash reserve for future opportunities. This isn't a market where you can set it and forget it. The Strait of Hormuz crisis could de-escalate tomorrow, or the Fed could surprise with a rate cut, changing the entire narrative for both assets. That's why it's critical to stay disciplined, stick to your strategy, and adjust your positions as the market evolves. For traders who are new to these markets, start small. Paper trade these strategies first, or use a demo account to get comfortable with the rules and risk management. Don't rush into trades, and don't let greed drive your decisions. The best traders aren't the ones who make the biggest profits on a single trade, they're the ones who stay in the game for years, consistently taking small, high-probability trades. For long-term investors, this is a once-in-a-decade opportunity to position your portfolio for a shift in the commodity markets. Gold's role as a safe haven is being challenged by oil, and the energy sector is set to outperform for the foreseeable future. But that doesn't mean you should abandon gold entirely. It still has a place in a diversified portfolio, especially if geopolitical tensions escalate. Further, the key is to rebalance your allocation, reducing your exposure to gold and increasing your exposure to oil and energy assets. At Alpha Market Meridian, we're committed to bringing you actionable, risk-managed strategies for every market condition. Tomorrow, we'll be back with a deep dive into the US dollar index, which is at the center of both the gold and oil trades we've discussed today. We'll break down the key levels, the Fed's next move, and how to trade the dollar in this volatile environment. Until then, stay disciplined, stay risk-managed, and remember, in the markets, it's not about being right, it's about being profitable over time. This is Alpha Market Meridian, signing off. See you tomorrow.